A quick one before our live stream starts. If you're not already subscribed to our YouTube channel, we go live there every day trading the markets, covering world news, and talking through setups in real time. Hit subscribe so you don't miss the next session.
Still doom scrolling? Brain rot taking over? You'll focus tomorrow, right? But what if tomorrow never comes? What if it all started with one small choice? The world won't wait for you. Opportunity is moving right now. One decision is all it takes to shift your momentum. Fuel your mind and watch possibilities open up. Small wins stack up, focus sharpens, growth begins. Everything changes the moment you focus. Lock in and make the switch today. Bring your ambition into focus. Trade with Switch Markets.
Are you still trading everything manually? More traders are moving to automation, running strategies 24/7, removing emotion, and staying consistent. Now with Switch Markets, you've got the tools to build and run your own automated trading systems, so your strategy delivers even when you're asleep.
Meet Switch Markets, a broker for ambitious people who want to trade the financial markets.
You mean that I can trade things like Forex, stocks, even gold with you?
Yes, you can even trade the coffee bean market with us.
What about digital currencies? Can I trade them too?
Absolutely. Maybe now's your time to get in.
Oh, and are you regulated?
Yes, we are.
And how easy is it to deposit and withdraw? Will you charge me any fees?
It's easy. Deposit and withdraw instantly. Nice and simple. And unlike that guy, we won't grab any fees from you.
Do you have a low spread trading account?
Any fees from you.
Do you have a low spread trading account?
We certainly do. Pick from our zero commission or our low spreads account. It's up to you.
Okay then, what makes you so different from every other broker out there?
Our 5-star rated real human customer support and our perks package worth thousands. No other broker can beat it.
So, who did you say you were again?
Switch to success. Trade with Switch Markets.
Getting started in trading shouldn't be complicated. You can open an account, get set up, and be ready to go pretty quickly. Now, if you've been thinking about it, take a look. Click the link in the description below. You can even start with a free demo account.
In trading, like climbing, the hardest step is to pause, hold, and trust your position. Ambition pulls you forward. Focus keeps you steady. Together, they take you higher. Bring your ambition into focus. Switch Markets.
Already trading with another broker? Fair enough. But if you haven't looked around lately, you might be missing out. Now, Switch Markets is picking up awards, offering tools most brokers don't, and their support actually shows up. It might be time for you to switch to Switch Markets. Click the link in the description below to get started today.
Discipline starts before the first punch is thrown. Focus sharpens in silence. Repetition builds control. Every movement prepares you for the fight ahead. Trading isn't luck. It's preparation. It's grit. Your fight is won long before the bell even rings. Champions trade with Switch Markets. It's time to bring your ambition into focus.
Are you still with the same broker? Now, there are better options out there. There's more tools, better support, and a platform built for traders. It's time that you demand more from your broker. Take a look at Switch Markets. This is what we do around here. We strip the audio. All right, I'm Shane Vernier. Welcome back to the trading room. Our audio's off, but we should be back a little bit live. Throwing a lot of switches today. We're trying to get this Kevin Warsh engagement up and running. I think we found it. It did take some doing, but we did find it. So I think we're going to be live here with Warsh in about 14 minutes. I'm looking forward to it. We've got some trade updates. We've also got some live trading and also some performance updates before we get into the speech. You're really going to have to pay attention to what Warsh says today, though, because it's big. It's absolutely big. What we're talking about is we're talking about bond yields. We're talking about inflation, Fed policy. This is a big one. And typically when we see the Jackson Hole Symposium, it's a bunch of rich guys milling around, maybe having a few drinks, maybe talking shop. Typically nothing happens at the Jackson Hole Symposium. However, we saw Jay Powell a few years ago really roil the market, saying, hey, listen, we're shifting from accommodative COVID policy into more restrictive policy. That sent the markets tumbling. Today, we're thinking Warsh may say something very similar about the bond market, about what's going on in the Strait of Hormuz and the Iran war. We also believe that he's going to talk a little bit about what the Fed may be thinking with interest rates. Now, there's a lot going on here, guys. I expect Warsh to say things that are going to be market movers. I don't expect him to talk very long. He's going to talk probably 10 minutes would be my guess, but what he says is going to be very important, so we're going to have to pay attention, and I am looking forward to it. I think it's going to be a lot of fun. We're going to trade the fallout. We're going to trade it live and then trade the fallout, so I'm really I'm pumped up, ready to go. We'll look at some of our performance metrics and things for the week. Not a very good week, but a pretty good month all in all, so I'm very happy with where we stand right now. We've got a trade idea out there in the dollar yen, the NASDAQ 100, and Bitcoin, so I'm going to dive into those right now. I'm getting you up to speed there. Out there in YouTube land, Kirsty, good to see you, Kirsty. Tina Jing, always a pleasure, Tina. Welcome. Eli, Shane, good morning. Yeah, good morning, good evening, good afternoon, wherever you may be. There you are. All right, Janetti, good to see you, Janetti, over in the How to Trade community. Tuku, always a pleasure, guys. All right, we got a lot of cover, and we're sort of burning daylight, so let's get right to it. Warsh speaks at Jackson Hole. That is why we're all here. The big man's going to talk. We'll see exactly what he says. Trade idea right here, dollar yen. This is definitely one that I'm looking at. I think that this level could come into play. We had Tokyo CPI last night, sort of a fascinating number that didn't do a whole heck of a lot to help the yen. So right now, sort of been a bullish week here for the dollar yen, up about 0.5%. I'm watching this topside resistance right around that 160.63 level. We're about 100 pips away. We could get there. We could get there when Warsh speaks. We could definitely get there. So I'm interested in potentially executing this trade from the 160.49 to the short. I think we could be in really good shape there if we do get a chance at that level. As far as other trade ideas, this was really a banger earlier this week. One of the trades that really makes you smile. It really did. Beautiful retracement right around that 29 area. We went long at about 29.075, and since then you're up about 600 points. So it was an absolutely fabulous trade idea. It was one of those that we're happy to execute any day of the week. We'll do Monday through Friday. We'll execute those, and then twice on Sunday. Right? Absolutely fantastic trade. I loved that one. This is an interesting one. Bitcoin explodes macro resistance up next. You can see we've been looking at that 12-month chart for Bitcoin. A long time frame, absolutely. What I would be saying right now, though, is Bitcoin is definitely in I would say, not necessarily a make or break time, but it's definitely showing signs of life after being just dead as fried chicken for seemingly months. There was our entry, 8150, 81750. We were camped out right there looking for the short, and you can see earlier today, we just didn't quite get it, topped out right around 815, somewhere in that zone. So we did the best we could to try to get that. We're still not out of there, but we're looking for a nice position trade to the short, and I think that's a pretty good one. Topside resistance at about 84,000. So I do think that we're in decent shape if we do get to push higher to really grab that short and feel pretty good about where we're at. So definitely want to be aggressive. I think today I'm going to talk about no donation. I'm going to talk about the psychology, but today is probably going to be a pretty aggressive day because the Fed is going to speak, and anytime the Fed speaks, we all should listen. He's not going to talk very long, but the markets should be going crazy when Warsh does talk. So we definitely want to cover that. Remember, week 35 today is the big one, and that's Kevin Warsh is going to speak. And anytime Warsh speaks right now, it's a big deal. I can't stress that enough. Sort of a ho-hum week, very, very quiet week. Not a great week at all. No donation Friday today. I don't know that today qualifies, but we're going to adhere to those rules today. I'm going to go through my P&L for the week, and then we're going to talk about a strategy of how we're going to trade this action during this session. So no donation Friday. If you have a winning week, 50% of your profits go in your pocket, at least 50% go in your pocket. I think it's very important to pay yourself for your time. A losing week, if it's a small losing week, you've got to trade as usual. Now, that's pretty much what we're going to do today, except I'm going to say if it's a big losing week, consider waiting till Monday. But today I think we're going to trade as normal, but I am going to cut probably my leverage a little bit because I don't want to make today a big losing day. We haven't had a good week at all. Neutral, usual trading, reduce leverage trading, or don't trade. So if you're at zero, you don't have to trade. You can do whatever you want. I'll look the other way. I won't tell anybody. Here's our metrics. Weekly performance for this week, not great. Down about 492. All in all, we got hit by 2 trades that really weren't fun at all. The copper trade was probably a bad one. We exited the gold trade, and that was probably our best trade of the week, only taking a 12-point loss there, 120. And then you see the big 550 loss on NASDAQ futures yesterday. That was a real challenge. That trade was a challenge. We got swept up in a news event and ended up just having to rip the Band-Aid off and get out. It was the right move. We didn't want to go hunting there. And then the last one was a natural gas that just sort of happened by just chance, and we got a bit of a bounce there, but no real money. Like I said, we exited that. We didn't really mean to take that trade. As far as the month goes, pretty good. I mean, that's the wrong slide, but the pretty good month though, really. Last week's performance was solid, 2,800. I feel pretty good about that. And then the week before I went on vacation, it was about 1,000. So doing pretty well realistically over the last 4 weeks. But this right here sort of sets us up for our psychology today. The last thing I want to do is lose the money that we've made here in the last month. That's the last thing we're going to do. I'm not going to do it today. Absolutely not. So what we're going to do is we're going to trade as usual, but I'm going to cut the leverage a little bit. We won't be trading 3 bangers in WTI crude. We won't be trading 2 lots in gold. And we won't be trading 2 lots in the E-mini NASDAQ. We're going to go down to 1 lot, and we're going to be conservative with what we do. Very, very important that we understand money management is the name of the game. I sound like a broken record, but it's because it is important. Just because you got a red number up for this week, it's nowhere near what last week's green number was, and the week before that's green number. Don't make small mistakes, big ones. Don't make moderate losing weeks catastrophic. We don't want to do that. If you're going to be a trader and you're serious about doing this for years and years and years, you got to think long term. We don't lose $5,000 today. That doesn't happen. We'll go down maybe another 500 and walk away down $1,000 for the week. I would be okay with that. But honestly, we've already sort of lost for the week. Now we're just looking to make a few good trades, build some momentum going into Monday so we can kill it next week. That's the name of the game, guys. That's absolutely the name of the game. I do talk more about money management and trades, live trade execution these days. Seems to be that's what folks want to see, and I'm more than happy to dive into that with 2 fists, both hands, and show you what I do and try to help out any way that I can. Packham, good to see you. Packham, welcome. Timbo Sloyce, wow, we were blessed with an early stream today. How you doing, mate? Doing very well, Timbo. Thank you. Voice is still a little raspy. I don't know when I'm going to kick this cold. That's for sure. Packham, you mean no 100 gold lots? Probably not today. Don't tempt me, though, Tuesday. Mark your calendar. Tuesday, we're going to go deep. Why not? Tuesday, Wednesday, Thursday, absolutely. Calvin, no donation Fridays. Calvin, good to see you, Calvin. Welcome. Hi, Shane. All well. I'm doing very well, Calvin. It's always good to see you. Always good to see veterans of the community, folks that have been in the market a long time trading. That's one of the great things about being able to interact with a lot of folks all around the world is that you do get an opportunity to talk shop with people that know what they're talking about, and that is one of my favorite things to do in the markets. All right, let's get right out to price action. We can look at some TPO charts if you want. I don't really like trading TPO this early in the day. Our value area really hasn't set up. In my view, we haven't seen enough volume, enough price action just yet. So we're going to watch Warsh talk, and then we're going to go around the horn. We'll look at some Forex pairs. We're going to look at some commodities, some indices. Right now, we're tentatively up. We have sort of a modest positive open. The NASDAQ's down just a little bit. Here's your NQ futures, just to go ahead and look. I am not looking to place a trade at all right now. I am not interested at all in placing a trade right now ahead of Warsh speaking. I think in 5 minutes when he takes the stage, it could be like a bomb going off. So I definitely want to be very, very careful. And you can see right here, guys, that NASDAQ chart is starting to show you that something's cooking here. Something's really cooking. I mean, that is textbook. Wipe out the shorts, wipe out the longs, and then the market's going to settle down. Warsh is going to speak, and then we'll start making decisions from there. I highly recommend after Warsh speaks, give this thing 2 to 3 minutes, maybe 5 minutes, and then we dive in. I'm probably going to give it 2 because we're on live and I get antsy and I'm aggressive today. So I want to trade, but we're going to let him talk because I expect some moves here. Now, it may turn out to be a nothing burger. It may. We've been hyping this thing up, but I will tell you that Jay Powell, 2023-ish, Jay Powell at the Jackson Hole Symposium rocked the markets. Absolutely rocked them. All right, here's a few things that we are going to be looking at from Kevin Warsh. Delivers his Jackson Hole speech Friday. Here's what to expect. Warsh delivers keynote speech. Prior central bank leaders have used the event to discuss broad policy initiatives, but here's considerably uncertainty about how ambitious Warsh will be in his remarks. Bottom line is this. This is all media gobbledygook. You can take whatever you want out of these articles. This is what we're looking for. We're looking for Warsh to talk about the bond rates. We want to hear about yields. We want to hear about what's going on in the bond markets. That's huge. We also, number two, we want to hear if he comments on Besant. We want to hear if he comments on the U.S. Treasury and the bond buyback. I think it's highly unlikely that he's going to talk about that, but I think that if he does, if he addresses what the Treasury is doing, it's going to bring this sense of, hey, there may be a crisis brewing. Believe it or not, I know that's sort of like, oh, Shane, come on, you're fear-mongering. No, I'm not. The buyback is very real. $4 billion in buyback, and Besant said the U.S. Treasury would tap their $1 trillion fund potentially to restore order to the bond market. Why are they doing this? Because the United States is leveraged to the hilt. The debt levels are extremely high, and with interest rates sort of holding firm, even though they're not historically high, even if they hold firm, we're in a tough position because just the debt service on that massive, the trillion, what is it, 40 trillion now? Even the debt service on that starts to eat up a good portion of your GDP. That's not good. That's not good. So we're watching this closely. We think that he's going to address the bond market in some fashion. If he does, that's going to be a big deal. Number two, forward guidance. Now, Warsh said we're not going to do forward guidance. He's going to get away from the dot plot. They're even going to cut down the number of the pressers that they do next year. He's probably only going to do one quarterly. It's fine with me. But what does that mean to the markets? Uncertainty. It means what's going on here? There's a new sheriff in town. This gentleman's going to do things a lot differently than Jay Powell did it and the previous administrations did it. We will see if it works. But there's major challenges with the debt out there, and there's major challenges right now, really, in Iran. You've got debt. You've got all these things coming to pass. You've got hacking. Chinese hackers, I guess, are hacking the power grid and the Senate and the Federal Reserve. This is some serious stuff. It's going to be great trading. That's all I can say about it. All right, let's take a look at gold. Here's a good look at gold futures. Gold futures breaking to the top. This is going to be December gold futures. We're not doing anything right now. I got to wait and see exactly what Warsh says and how this plays out. We've got T-minus about a minute 15 until he speaks. Big move out of gold. Break from the point of control. Now we're starting to trend a little bit higher. It's not a trend. Don't get fooled. I misspoke. All you're looking at is about 0.31% gain, but a big 30-minute bar if people are getting ready. Let me see. Naomi Rising, good to see you, Naomi. Welcome. Hi, Shane. Just got done catching up on your live stream from yesterday. Every time you sang lyrics to a song, I busted out laughing. Man, I can't sing. Maybe a little Barry White every now and then, but I can't sing. But thank you, Naomi. I appreciate it. Let me see. When is Warsh dumping the dollar? That's a good question. That's a good question. Pythias, I am here for gold. We're going to trade gold. Believe me. We're going to trade gold. That's for sure. I think this is going to be a big one, guys. All right, let's go ahead and see if I can get a little volume going. You guys should hear some classical. If you give me a thumbs up, that'd be great. All right, of course, they just turned the music off. All right. I am here for gold. I'm here for money. That's why we're here. We're going to trade some gold, though. Look at this gold market. I mean, absolutely going crazy. Absolutely going crazy. Spike high. Now you've got incredible compression. I would be extremely careful here, guys. Extremely careful. Look at gold. Gold's going absolutely crazy. Booked profit. I am in gold from 45.90 with one lot.
Have you heard about pop-on siding?
It's not a bad move. Not a bad move at all. We're still waiting. We're waiting for Warsh to get out here. I'm watching it on two different channels just in case we got a channel that may be a dud. We will make a quick adjustment.
Incredible hospitality. Everybody here is in debt.
Yep, he's speaking.
Here at the Federal Reserve Bank of Kansas City. Jeff, our thanks to you and your team. Now, he and the other planners here have some recreation options lined up for later today.
Everybody
I advise
hear
you
it.
to be very careful with your choices. As I learned years ago, you can take two different kinds of hikes on the trails around Jackson. I can sum up my hikes with former Vice Chairman Don Cohn with two words: I survived. These steely marathon death marches revealed a sign of Don that I was not ready for. But there's another kind of hike. This one was with former Chairman Ben Bernanke, another dear old colleague.
All right, Timbo, thank you.
With Ben, it was a much more leisurely pace, an easy stroll along the wandering trails of the Rockefeller Preserve. So before setting out today, my recommendation is to do a wellness check. Ask yourself, is this a Cohn day or a Bernanke day? The best thing about this gathering is that it helps us all get out here to the mountains and clear our minds and think straight about our world and our time. For me, it feels like the right place and the right audience for a real engagement with the ideas that matter most.
Here we go.
Innovation, as Kristen mentioned, is the conference theme. And I believe the public and the markets understand that innovations in the conduct of Fed policy will help deliver price stability alongside full employment. So here's a quick overview of what I'll cover in my remarks this morning. You can call it an outline, you can call it a trail map, but please just don't call it forward guidance. First, I'll touch on a few of the longer-term questions we're asking at the Fed about the latest general-purpose technology, AI, and where it might take the economy. Then I'll reflect a bit on the practice of forward guidance and the interaction between the central bank and financial markets. Next, I'll present some of the key principles that I believe should guide the conduct of monetary policy. And finally, I'll give you my assessment of what's happening in the economy. So first, I think we should try to prepare a bit for future policy conjunctures. With the unchanging picture of the Tetons as our backdrop, we are here to survey an economic landscape that is anything but static. It wasn't so long ago, including in rooms like this, in the run-up to the crisis of 2008 and over the decade that followed, when economists and policymakers were speaking of secular stagnation, speaking of a global savings glut. It was a widely held view that an excess of capital would sit on the sidelines for a very long, long time.
He's talking
because
crisis.
there just wouldn't be enough compelling investment opportunities. All the good stuff, you'll recall, had been invented. So growth would be low and slow. Well, times sure have changed. We've come to a hinge point in history, to borrow a phrase, a framing from my former mentor, George Shultz. To cite the clearest example, progress in AI, the 80-year-old name for the newest technology, has been faster even than its evangelists predicted just a couple of years ago. The potential for substantially higher growth is on the rise. Ever-expanding pools of capital pouring into AI-related infrastructure of all sorts. A kind of super Moore's law seems to be playing out. Scaling laws, too, are changing both the method and speed of innovation. Capital and labor have combined to create large language models at the heart of AI. Users buy tokens to gain access to these models. Reports put annualized token sales for the two leading labs alone at more than $100 billion, an increase of 500% from just 12 months ago. We at the Fed, we watch all this attentively. We recognize that AI is a new variable, potentially a new factor of production that will have consequences both for the economy and for the conduct of monetary policy. It opens up some major lines of inquiry. Will the application of AI cause a significant sustained rise in productivity across the economy? If so, when? Will token usage be complementary or competitive to labor? Will the next generation of AI models demand even greater capital intensity too? Or will the models themselves help devise a capital-light solution? Among the other yet unknowns is the resulting market structure. Who gets to make the money? It It's not obvious where the returns on capital will land or on what time scale. Early on, how much of the surplus goes to owners of scarce assets, the AI labs or chip makers or energy producers or cloud providers? Over time, how much of that value accrues to businesses and consumers? And importantly, what are the implications for workers and for the employment side of the Fed's mandate? Likewise, we don't yet know the equilibrium price of the tokens that give access to these models. Might there be a heterogeneity of tokens such that growing sums will be paid for the access to the best models, those at the frontier? Will token prices for older models fall to the level of their marginal cost? Well, we'll be thinking through these matters with the help of a task force on productivity and jobs. My early check-ins with the leaders of that task force and the rest have been very encouraging. To be clear, though, their recommendations will come later and have no bearing on decisions we make in the current policy conjuncture. But I believe that for future policy challenges, this intellectual investment today will leave us much better prepared for tomorrow. Next, let me say a word about forward guidance and its substitutes. As our task forces go about their work, as you might know, I'm not waiting to introduce innovations at the Fed to help make us fit for purpose. To highlight one example, I've set out to change the form and function of the Fed chairman's so-called forward guidance. You might know about my longtime discomfort with early pronouncements of future policy decisions. I much prefer another path, and now we'll make the case for it. Transparency in communications about future policy decisions is not an end unto itself. Communications must be in service to the Fed's paramount responsibility. And what decisions is not an end unto itself. Communications must be in service to the Fed's paramount responsibility. And what is that? That's getting policy right. Forward guidance as a regular practice was adopted by my colleagues and me during the global financial crisis.
Wow.
It was essential at the time, and we introduced it with much fanfare. But as with other legacies of crises past, I believe the practice has outstayed its welcome. In normal times, the role of forward guidance should be limited and circumscribed. Otherwise, it risks creating ambiguity in the name of clarity. Oversharing policy deliberations and overcommitting to future decisions can lead markets, businesses, and households astray. And I believe when policymakers make quasi-commitments on interest rates throughout the cycle, we inhibit our own freedom to make the right calls when it's time to
It used to feel like documentation was my entire job.
And they put a commercial in.
I now have Scribe
for
on my side.
25
All you have to do
seconds.
is
They put a
complete
commercial
any task
in.
while capturing a screen recording.
Can you believe
then
this?
Scribe watches what you do and takes screenshots, writes out
Absolutely
all of the steps in
unbelievable.
detail,
They
and
ran
automatically
an
creates
effing
a full
commercial
how-to guide
during the
that's ready to
guy's
share with
speech.
any new
His
hire.
speech has
And
already been
since they can
released to
reference it at
CNBC
any
about
time,
2 minutes
no
before
more
he went
endless
on.
back and forth
This is
messages.
crazy,
You've
man.
got to
They
get
are
some time
manipulating
back
the
for
market
yourself
at every
by
turn.
heading
This is a
scribe.com.
national feed, and they put a commercial on. I don't even know what else to say about it. Unreal. Absolutely unreal. Another commercial. Wow. This is unbelievable, guys. I mean, just watch the gold market, I guess. I mean, this is unbelievable. This is a CNBC news channel. They put a friggin' commercial in.
At the same time, market participants themselves should be tracking real information.
I mean, we're playing
about
for
the
money
real
here,
economy.
and they're running commercials.
They should draw their own conclusions, form their own expectations on things like output and employment and inflation.
Yes, things are really wrong in this world.
They too should stay sharply attuned to risks.
That's insider. That's ridiculous.
In my view, the Fed should be humble and never naive. The Fed plays an essential role in the economy.
An AI commercial.
Our tools are powerful. We determine the path of short-term interest rates, and market participants will always try to anticipate what we will do next. But we should not indulge a regime in which market participants are looking primarily to the Fed for their next trade. The economic literature has long described the distorting effects, what it called the Hall of Mirrors problem. If markets rely materially on the Fed's guidance and the Fed relies on market prices, we're more likely to be blinded to new developments, more likely to be caught unprepared, and more likely to commit errors in policymaking. Now, perversely, market participants are unlikely to bear the biggest costs of the
He's
Hall of
going
Mirrors
long
problem.
today, really long.
Most serious harm is likely to befall those without any financial assets. If the Fed gets inflation wrong and judges the economy wrong, who gets the worst of it? Not the financial high flyers.
And when do we get the half?
Hardworking Americans are the ones left to deal with inflation that's too high or jobs that suddenly appear less secure. So, if forward guidance is ill-suited to normal times, how about the new Fed chief commits at a meeting just like this to some explicit reaction function? Surely he could tell us his interest rate path if, say, the data were to come in hot or cold. Well, I wish our understanding of the economy were so precise as to provide a mechanical, tried and true answer, that some simple function, like a Taylor rule, could be rigorously relied upon. But our knowledge just does not extend that far, at least not yet. And other factors most relevant to the proper conduct of monetary policy, they change over time. Providing forecasts to illustrate the Fed's reaction function works better in theory than in practice, better in the lab than in the field. I am not alone in noticing that forward guidance in 2021, to cite just one example, might well have slowed the policy response to high inflation. In my term as chairman, my colleagues and I will endeavor to construct more reliable models, more robust rules, and we'll do this knowing that accuracy in forecasting is still just an aspiration, with so much changing so fast in our geopolitics, global supply chains, technology. It's wise to be modest about what we can and cannot know as we sit here today. In the same spirit, we should receive the full range of ideas on matters that may inform the Fed's monetary policy discussions. If the aim is optimal decision making, and it should be, we should not crowd out views on the economy. How then to chart a better path to policy? In the balance of my remarks, I will share with you some key principles that guide my thinking on the appropriate conduct of monetary policy. And then I'll offer my promised assessment of the economy. So let's turn first to principles. First, I've noticed in this line of work, yesterday's news has a way of getting mistaken for what's happening right now. The challenge is to know the difference. In other words, we must interrogate reality. Make sure we're not setting forward-looking policy based on stale or inaccurate data. Nor should we rely on isolated data points. Trends matter most. The Fed's a decision-making agency. We make choices amid uncertainty, and the data upon which we draw must be relevant, contemporaneous, accurate, and as actionable as possible. Second principle. The Fed's actions are intended to ensure that the aggregate demand side of the economy is broadly consistent with aggregate supply. However, all we observe directly is activity. We never see and can only infer what's really happening on the supply side. Hence, evaluating the current and expected balance between aggregate supply and aggregate demand is imprecise. Third principle. There should be no misunderstanding. The Fed's price stability objective of 2%, as measured by the PCE price index, is a firm, fixed target. Let me be equally clear about another aspect of this objective.
3.7, you're way
Price
off.
stability is not self-executing, nor is inflation necessarily mean reverting. It's the Fed's job to deliver stable prices, no excuses. Fourth principle, the Fed also bears responsibility for maximum employment. Achieving both sides of our mandate over the medium term is not an either-or proposition. I do not believe the Fed's dual mandate works at cross purposes. After all, high inflation itself is very harmful to economic prosperity. Fifth principle, short-term interest rates are the predominant tool to achieve the dual mandate.
Uh-oh.
Unconventional policies to spur economic activity may suit genuine crises, of which we all have much experience.
There it is, the bonds.
But they should otherwise be used sparingly, if at all.
He's talking about bonds and crises right there.
Money
Write
matters.
that down.
I know it's not fashionable these days.
They're in trouble. Something's
My
going
view
on.
is that money has something important to do with monetary policy. We should pay attention to money created by the central bank and money that comes from the banking and financial system. It's true that financial innovations, the subject of this conference, and other factors alter the mechanics that link the monetary base, the velocity of money, and the broader economy. But that is scarcely a reason to ignore the ultimate effects of money on financial conditions and prices. Finally, a quieter Fed, a more purposeful Fed in its communications, is better able to meet its objectives. And we can be held accountable for delivering on our remit, the only true test of our credibility. To borrow a line from General Chuck Yeager, at the moment of truth, there are either reasons or results. So having heard a little bit about AI and general purpose technologies, having heard a little bit about the next policy conjuncture, a little bit on principles, let's turn to the economy today. Given those principles, how do I read the economy? What's really going on outside the window? It's a little ironic, there are no windows in this room, but there are big ones at the Federal Reserve. And we've been using those in my first 100 days. And I expect we're going to continue to use those in the period right ahead of us. Now, you may have read in the July minutes the unanimous view of the FOMC. Labor markets were stable, output solid, but inflation remained too high. A good majority of my colleagues and I thought the wiser course was to await new information in the intermeeting period, especially given possible developments in supply chains, investment flows, and geopolitics, before deciding whether a change in interest rate policy was advisable. And we expressed our joint readiness to act as circumstances require. For my part today, as we sit here, I'm impressed by the overall performance of the economy, which appears to have strengthened. One indicator of strength is how well an economy holds up under stress, how well it holds up under shocks. On that score, both Main Street and Wall Street have been remarkably resilient. Several other observations. Business CapEx is rising rapidly. The 4-quarter change in investment in equipment and intangibles has been around 9%, its highest growth rate since 2021. And more than half of the CapEx growth can likely be ascribed to the build-out related to AI. What about profits?
What about them?
For the firms in the S&P, profits have grown more than 20% over the past year alone.
Wrap it up, Warsh.
Profit margins are quite elevated relative to history. Overall equity and market volatility, quite low. We're staying keenly focused on market internals, watching performance across sectors. Expectations for both growth in CapEx and corporate earnings are running quite high. I continue to watch the change in the growth rates, the second derivative, the follow-on effects on asset prices, business confidence, consumer incomes and spending are equally important to gauge. Credit spreads on corporate bonds and leveraged loans are near the low end of their historical averages, and issue volumes this year quite strong. Looking beyond fixed income markets to the banking business, in the July so-called SLOOS survey, banks tell us that standards for C&I loans are on the easier end of their historical ranges. That helps explain their growth that we've seen this year in these loans. In my view, credit and loan markets are showing few signs of policy restraint. Now, certain sectors, like housing and agriculture, are showing strains. But on balance, I would be hard-pressed to describe broad financial conditions as restrictive. Real consumer spending has been healthy despite these shocks, increasing more than 2% over the past 4 quarters. If you combine consumption with the brisk investment we talked about earlier, private domestic financial purchases have also risen. These purchases have increased at a pace of nearly 3% or so far this year. That's a measure that typically carries more signal than GDP. The trend here too, positive. So on the employment side of the Fed's dual mandate, our country's doing well. Labor markets are quite stable. The jobless rate at 4.1% remains low by historical standards and hasn't changed much in a couple of years. Unemployment claims on a 4-week moving average, an empirically robust real-time indicator, are near their lowest level in decades. In my view, the relatively low turnover in today's labor market is partly a result of the significant rematching between employers and employees that happened in the post-pandemic environment. But when labor supply is barely growing, monthly job gains are naturally going to run low. There are always areas of concerns in the labor market.
It's getting you ready for a rate hike.
For example, among recent graduates. In general, though, people who want to work, by and large, are holding or finding jobs. They may well be concerned about future labor disruptions, but as of now, I believe the labor markets are broadly consistent with full employment. But on the price stability side of our mandate, the numbers are more concerning. The Fed's preferred measure of inflation, the one I talked about earlier, the 12-month change in the PC price index stands at 3.7%, with the 6-month change a little above 4%. The comparable measures from the CPI index are also elevated, as are core measures both of PCE and CPI inflation. And none of these measures are perfect, but they all tell a similar story. Inflation is running above our 2% target. So the Fed's predominant focus right now should be on prices. So what's our job? The job for policymakers is to capture underlying trend inflation. Easier said than done. We want to gauge whether underlying inflation is rising, falling, or seems to be stuck in place. We also want to understand not just the direction of travel, but the speed. Each of these broad inflation measures have fallen significantly from their highs of a few years ago, but progress over the last couple of years has been more modest. And while this summer's PCE and CPI readings were better than expected, they do not tell me that underlying trends have meaningfully improved. The data also show moderate wage growth, but in my view, in tracking underlying inflation, wage growth has not proven a reliable indicator of future inflation for a very long time.
Very hawkish, guys. Very, very hawkish.
So to try to gauge underlying inflation, I want to tell you about a couple things I've always looked to.
This guy's running way long.
I find it instructive to disaggregate the 199 individual components of the PC price measure. Over the last 12 months, 54% of goods and services in this basket showed price increases above 3%. This is well below the post-pandemic highs of about 77%, but it remains well above the level of 32% in a couple of the decades that preceded the pandemic. Looking over just the last 6 months, the conclusion is similar. 49% of goods and services in the PC basket showed price increases above 3%, Again, this is well below the post-pandemic highs, but still elevated, quite elevated. The recent rise in overall commodity prices also bears watching. What we need to judge is whether the trends we see. Now, it matters too whether the
So what, they hacked the stream now?
and never naive. The Fed plays an essential role in the economy, and inflation compensation measures from the swaps market send a strong and similar message, especially in light of recent developments. It's a credit to the Fed as an institution, consistent with the best of the Fed's traditions, that market prices show confidence that we will deliver price stability. And I can assure you, they're right. The thing about market measures of inflation expectations in economic history, I know some economic historians in the audience, is they all tend to look really strong and durable until they don't. These expectations are not pushed around easily, and right now they are very well anchored. But they must be closely minded, and it's the Fed's job.
Why are you still using bots for your meetings? How else am I going to remember what happened?
In the PC basket showed price increases above 3%. Again, this is well below the post-pandemic highs, and I can assure you, they're right. The thing about market measures of inflation expectations in economic history, I know some economic historians in the audience, is they all tend to look really strong and durable until they don't. These expectations are not pushed around easily, and right now they are very well anchored. But they must be closely minded, and it's the Fed's job to make sure that inflation expectations do not get unanchored. Now, there is one signal nobody can miss. The responsibility for 65 months of sustained elevated inflation sits squarely with the central bank, and that's where it belongs. So here is my standard. We must be confident that underlying inflation is moving to our objective clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep. So I've covered quite a bit of ground in the last 25 minutes or so. Let me see if I can conclude this way. I stand here today committed to a discipline, not a decision. My Fed colleagues and I are hardly the first to hold these positions in a time of great consequence. We are determined to redeem the time by doing our very best work. For those of you that know us, you'll know the following is true. We take our responsibility seriously, with humility, and with resolve. We know so much depends on the choices we make. Sound monetary policy helps households and businesses to prosper. When carried out effectively, it broadens and deepens the momentum of our economy and helps to secure America's leadership in the world. And I know that our country needs us to think carefully and act wisely, perhaps now more than ever.
Wrap it up.
It's a tremendous honor to serve once again at the Federal Reserve. I'm truly grateful for the encouragement, good counsel, and the warm reception I've received in my first 100 days from my colleagues. I'm also honored and grateful for the views that I've gotten, solicited and unsolicited, from so many of you in this room. For that, and for your kind attention this morning, I say thank you. Let's get on with the rest of the program.
Okay, a lot going on right there. Absolutely a lot going on right there. A couple of observations before we dive into some trades. The first thing that I would say is that, of course, the U.S. dollar was rising, and it was rising big, and the reason why was because he went hawkish. No question about it. Essentially what happened was Warsh built the case for a rate hike. He sort of massaged it. Think about what he said. He said, okay, corporate profits are there. The growth is there. The jobs market's strong, but pricing stability is a real problem. PCE said, basically PCE came out Wednesday. He said that 2% objective in PCE was their target, was their goal, running about 3.7. So we're well off of that. I thought the 65-month statement of sustained inflation, that goes right back to COVID. The COVID era, unlimited QE, we've sort of been yelling that from the mountaintops for the last 3 years. The Fed did not want to basically step in and take care of that. They didn't raise interest rates. Interest rates probably should have went to 10 or 12% to try to take the slack out of the economy. They never did it. And so now Warsh is suggesting that they're going to have to do it. And if they're going to have to do it, well, I mean, it comes down to this. He stressed that interest rates were their number one tool. What do you have right here? Well, we have shifting dynamic here for September. Now, all of a sudden, we're pricing about a 55 to 45, about a 50-50 chance that you're going to get a rate hike in September, because he came out and he said, listen, CPI doesn't mean much, PPI doesn't mean much. We're looking at the broader trend, and nothing has really changed. And he's right. He's 100% right. The question is do they have the guts to step up and hike interest rates, especially during a period of war? I mean, the Iran situation, nobody really knows what's going on there. You're going to hike interest rates with high energy. That all suggests a major sell-off. The last observation I'll make is I mean, he spent a good 10 minutes talking about AI, breaking down AI. Why? Is this economy a one-trick pony? Is it all NVIDIA? NVIDIA is 7% of the S&P 500. Is it all NVIDIA? Are we talking about chip makers and AI and that's it for the U.S. economy? If that's the way that it's going to be, then you better get some cheap money out there, because the AI and the tech always needs cheap money to grow. So what do we have? We have shifting expectations. Right here you can see 1 month ago there was really good chance that you were going to get that rate hike, and then then it shifted down, and now it's sort of back to where we think it's going to be a 50-50 shot. Let's go to December 2026. Take a look at our interest rate expectations there. About 50-50, right? There's your bell curve. That's more like it. We're looking at about an 82% chance of getting at least a 25 basis point rate hike, and more than likely a half point. Do they go to 4%? If they go to 4% and the Iran war is not over and the Strait of Hormuz is not open and you're looking at $85 crude oil in the wintertime with 4% interest rates, I would say that you're going into a recession in 2027. I would say that definitely is one of those things. Let me see. Eli, sounds like AI made his speech. You think he chat GBT'd his speech? Now that's funny. One last thing I'm going to say is this. His comments in that speech hit CNBC. They were written comments. They were prepared, and they leaked it before the speech. You saw the way price action behaved before Warsh even began talking. Now, as far as the ads go, I must have been on the wrong channel or something. I'll take responsibility for that. But I have to tell you that this is why trading these events, something like this, is problematic at best. High risk. High risk, no question about it. All right, so let's take a look at our gold TPO charts. We're going to look at some Fibonacci's too. We've got some pretty good moves here. We may be able to get a nice gold trade just trading Fibonacci's. But TPO, I would love to sell the point of control right up there, 46.54. It's just a question of whether we get back there. E-mini NASDAQ. NASDAQ's starting to break out a little bit to the top, but I mean, this is sort of the kiss of death formation, guys. Doji, sort of a long-legged doji. I mean, that is just Chop City in there. The more Warsh talked about AI and interest rates, the more that thing got choppy. So for me, very, very tight day right now, about 8:30 in the morning my time, 10:30 a.m. Eastern. These things have been open for about 3 hours. No, about 1 hour, but 3 hours. Never mind, I got my time zones. Market's been open an hour. So if you're looking at maybe playing an orb strategy, a 2-bar orb, essentially there it is for you on your E-mini NASDAQ or your NASDAQ futures. There's your 2-bar orb. Would you be playing an orb today? I don't know. I think it's inherently risky, but right in there, if you're playing a 15-minute chart, you've already lost. That's why orbs on days like today when you got a big time speech, it doesn't work. I mean, it's too choppy in there. So right there, bar 1, bar 2, that would have been your sell. You lost. Back it off to a 30-minute. Now, potentially, this could be a decent trade, a day trade. There's going to be a lot of traders that pile in on this initial break. I don't think I would do that. I think I would be very, very careful with this price action. No clear move on the markets. I expected something bigger. Yeah, me too. It's just Chop City. When Powell spoke, I got paid. Forward tested on Warsh, and the same results. There you go. Let me see Timbo Slice or Sloice. Oh, Warsh going against Trump and hikes. This is the Powell saga all over again. I think Warsh is going to end up being a dove at the end of the day. He set the stage for less forward guidance, which is a huge deal, an absolutely huge deal. Gold absolutely slingshotting back into this range. So if you're trading gold probably the rest of the day, definitely be looking at this. It's bearish for gold, though. Let's go spot gold here. Pull up a 5-minute chart. Let's have a look. It's Chop City. Absolute Chop City. Spike high, spike low, rotation, 38%, 62%. I don't like any of this. I think that this is really going to be a tough day to trade. That is just chop, 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 chop. That's really brutal. That is really brutal. Let's go and take our TPO charts off of the screen here. Let's get rid of everything on there and step back and look at maybe a daily. Let's look at a daily and see what's going on. Yeah, I mean, we pretty much already missed the daily trade, but that's okay. Right there, spike low to a spike high. What do you got? Spike low to a spike high. Really dirty around that 38% level. 45,554, 45,557.50. Probably going to be a pretty good bid the rest of the session. I would be looking at that. Let me see. Eli, I honestly thought he was going to dump the dollar, stuck to my technicals. Yeah, he went hawkish today. Warsh went hawkish. So right in this zone right here, 45,554, I think you could probably step up and grab a bid there if you wanted it. That's a pretty good day trade if you do get it, and you may get it a little bit later today. Let's go back on over to our gold futures. Take it down to our 30-minute chart and pull our market profile back up. This is really a good time of day to be trading this type of strategy. You'll notice we trade metals later in the day and the market's really slow and sluggish. You're not seeing that right now. You're seeing a lot of participation, significant volumes, not necessarily at every price point, but you've got good movement, and theoretically that's exactly what we need to trade. But for right this minute, I would be conservative with gold. I mean, it's jumping all around. I definitely want to sell the point of control. I think that's a fantastic area to be looking to take a short and potentially make some money. But as far as I'm concerned, I mean, that is so far off the pace right now. I don't know that we're going to get it. All right, let's go around the horn and see if we can find a trade, scope a trade out. Here's the E-mini NASDAQ. It looks like that bullish breakout of that 2-bar orb is setting up a bit. I would be careful with it, though. I really would. I'm not sure that opening range is worth a salt. I'm really not. Right here, okay, this E-mini Dow would be a fantastic opportunity to sell right up here. Point of control, theoretically, we're off about another 50 points, but we are moving. We may get this trade right now. What Warsh said, it all pointed towards being sort of hawkish, and it almost felt to me like he was trying to explain himself. And I understand that that's a big part of what policymakers do. They try to explain the rationale behind their decisions. There's an old saying, if you find yourself explaining yourself, you're weak. If you're sitting there explaining your decisions, typically you're in a weak position. I agree that a policymaker and politicians and things, they should explain themselves just so we follow their thought process. But what Kevin Warsh did today, he came out and he talked for about 35 minutes. That was way too long. He should have given a quick 10-minute speech, but he had a lot of ground to cover. And what he basically did today was sort of set the stage for your rate hike, explained why they were going to do what they were going to do, and then explained how things were going to be different moving forward. And then he also sort of was making the case, it felt like he was making the case to the administration that, hey, listen, the jobs market's strong. There's plenty of growth in the corporate sector. The markets are up. The price is a real problem here. And we don't believe CPI and we don't believe PPI. We believe that longer trend, that inflation essentially is what he said. It's entrenched. 65 months of inflation growth, significant inflation growth since COVID-19. That means Jay Powell was a complete failure. A complete failure. And think about, go back in your mind's eye here, and before we get into this trade right here, think about what that means. It means that all the crying out of the White House for too late Powell, and he's got to cut rates, he's got to cut rates, he's got to cut rates. Warsh comes in and says, hey, listen, we've got interest rates that are probably way too low. That is what he said in a roundabout way. He said corporate growth is strong, jobs market's as good as it's ever been. That's debatable. And then he comes right back to pricing stability and then cites the 65 months of inflation growth. Essentially, that makes, all right, our point of control just changed. Let's go ahead and take that sell. See if we can get a little payoff here. We should get filled any minute. Go down to a 1 minute chart. That's why you got to be on your toes with that POC, right? That looks like we didn't get filled. That's okay. Remember, early in the day, the point of control is not quite as reliable as they are late in the day. We didn't get the trade for whatever reason, and there's sort of your sell-off and your little score there. But what I'm saying is this, 65 months divided by 12, that's 5.4 years. That's 5.5 years. That takes you right back to the COVID era in March of 2020. Unlimited QE, I've been saying it for a long time. It essentially broke the financial system. It essentially broke it. And right now, without hiking interest rates to a big-time level, you're never going to get the cat back in the bag, if you even can. The rabbit back in the hat, whatever you want to say. I mean, it's just not possible. So somebody's got to be, they got to wear the big boy pants. They got to decide that, okay, it's time to hike rates. Is Warsh the guy? He's not supposed to be. That's not why Trump picked him, but could definitely be that guy. Gold, buy or sell. Now let's look at gold. Honestly, you're ranging around towards the bottom of the range or the bottom of this area, bottom of this quadrant. I think that it's just really hard. I hate to say neither. If you wanted to take a position, I would take one to the short, but we could easily see gold slingshot back up in here and settle for the day. So I probably wouldn't even be trading gold. Honestly, full disclosure. S&P 500 breaking to the top. Now, how about this trade right here? Do we want to sell right up here, maybe the top of that bar? Maybe sell right up there near the intraday high, which would be the top of our Kevin Warsh speech range. We could do it. We could sell right up there. There's nothing wrong with it. It's a higher risk trade. What do we got right there? We've got a daily high right up there at 77.60.50. Somewhere in there, we're selling 79.59.50. Okay, so now we're trending right now. We're trending higher. We're making new highs. Of course, we didn't get filled. That seems to be the modus operandi today. But is this a decent trade? You have to play it like a rotational trade, meaning if this thing breaks out against us, then we're going to go ahead and skip out, right? So right there's the top of your Warsh range. You definitely have to know where that is. That was when he gave his speech. Top right up there is 77.60.50. That is going to be your daily high. Now, if you look at your market profile, not much volume up there. We really don't know what's happening. What is, did we get hit perfectly? Yeah, 77.60.25. We did not get filled. That shouldn't surprise anybody. It seems to be exactly what's happening to us today. Let me see, Timbo Slice. So America is about to pay more interest over their debt now, as well as if they do raise rates. Yeah. Okay, so right here, we're officially short. A little bit of a breakout here in the S&P 500. Let's go ahead and take our take profit maybe down in here. Starting to run against us a bit. I'm not really overly excited about holding a position when this thing looks like it's breaking to the top side. 300, 325. Let's go ahead and go down to our 1 minute chart and see about managing this. Nice little breakout, though. Typically, that right there is where we wanted to get filled. Now the market's running against us a little bit. Back down 275, 250. It's really been indicative of the week that we've had. Realistically, are we playing rotation? It looks like these markets are breaking to the top side now. A little bit of a break, 350, 375. Let's go ahead and wait another minute or two and see exactly where this sets up. Typically, when the E-mini S&P 500 breaks, you don't want to be any part of it. Let's go ahead and let this thing set up for about another 10 seconds or so. See exactly how much this one costs us. But I'm about at my pain threshold for the week. This would probably be the last trade of the week that I would take, and then we would go ahead and probably be looking to exit and manage a little risk. Stop loss right here. You've just got to knock yourself out right around 500. Is it that a great trade? No, not really. It's not. Markets broke above that Warsh high. Typically, we should have been filled right there on our first time up and then got our money right in there. But of course, we didn't get filled. Probably should have pulled the order from the market. Right now, the market's sort of rotating back down a little bit towards our entry point. But realistically, you can see that things are starting to trend a little bit higher. Really no rhyme or reason for it. He was hawkish today. You're probably going to see a retracement back near square or flat by the end of the session. But the real question is, as a retail trader, a small retail trader that's involved with derivatives, trading leverage positions, you don't have enough money to hold this thing for the rest of the day betting that it goes down. Because if it does go up, Maybe Trump comes out and says something. Maybe he comes out and starts ripping Warsh, or maybe the administration makes a move. Maybe Scott Bessent comes out and says we're going to buy more bonds. We're going to do everything we can to dilute the financial system and the U.S. dollar. Maybe they do all those things. That's why as a retail trader, you've got to have stop losses. We will give that one more tick to bleed, but honestly, it's just one of those things where you're going to see more than likely we'll get stopped out on this just because the market is moving a bit higher right now. We may see rotation back down into the guts, but probably not until later today. You pretty much know instantly when you're trading rotation. When you're trading a rotational trade up towards the top of maybe an event range, you know almost immediately if you're going to get banged. Right there, we got banged. The bidders are there, the retracement's there. Now we're going to go up or we're going to run our stops, and that's going to be pretty much it as far as me wanting to hold any sort of short position here. I always like getting out of these things early. Believe me, you do not want to be around if this thing trends higher and you finish up 1% and everybody's wondering why. You can see right here, we're going to get nailed. We're going to get knocked out of this 65.75. It would take a major reversal for us not to get stopped. It's hard taking stops repeatedly. It's hard. It really is, especially on 1-minute charts, things that are really tight, but you've got to do it. If you're going to trade and you're going to be in this game, you got to cut these things off because there is no rule on how high this market can go today. No rule at all. No rule at all. So right there, bang, we got out. Forget it. It's over. So as far as I'm concerned, the last 2 days have been incredibly difficult. We had a defined risk management, what we were going to risk today, about 500. That's fine. We went ahead and took the loss. This right here, we probably could have got out with a really nice tight scalp had we been filled. Probably could have pulled it. In my opinion, though, is this worth even trading the rest of today? I would be very careful with what I do. For me personally, hasn't gone real well the last 2 days. I'm more than happy just to rack them, go home for August still very much in the green and not really worry about what happens. Come back ready to go in September. After Labor Day, business picks up, and it picks up in a big, big way. So that right there sealed our fate for a red week, but it's not a bad red week. And that's the name of the game, guys. Keep your losses manageable. 1 to 3% of your trading account, maybe 5%. I would look the other way on 7%, but as far as I'm concerned, this is going to be one of the more challenging trading days that you're going to have. So let's go ahead and review that E-mini S&P 500 trade just because it was a piece of garbage. Nice compression right there. We were looking at that Warsh. We were looking right there at that Warsh range, and now E-mini S&P 500 is breaking to the top side. You can see right there, starting to make new highs, trend a little bit higher. Is the same true for the NASDAQ? Let's look at the NASDAQ real quick. You can see E-mini NASDAQ. Okay, there's your break. So now all of a sudden we're making new highs. How about the Dow? How about the Dow? Dow right there, that probably would have been our sell, right? Sell that point of control and get involved. The Dow is the one that's sort of in a log jam. Very, very flat, trading right inside of that value area. But the NASDAQ and the S&P 500 have broken. Let's go ahead and check one thing real quick. NVIDIA is a major player, a major player in all this in 30-minute chart. What is NVIDIA doing for the day? Down a little bit for the day. Be surprising to get a trend day out of the E-mini S&P 500 and the NASDAQ with NVIDIA flatlining. I would expect either the index is going to drag NVIDIA higher or NVIDIA is going to drag the indexes down. That's for sure. All right, guys, let's take a look. I got way behind. Okay, let's go. AG Steel, AGS Steel, gold buy or sell now. To me, you could sell it. You could certainly sell it if you wanted to. I just think it's problematic. Stocks are up, gold's down. Maybe the U.S. dollar's given back some of the gains since Warsh spoke, but that was a really hawkish situation. That's for sure. Let me see. Eli, Shane, your no donation Friday has given me 3-day weekends. Thanks for that. The extra day off helps with my psychology and allows to forward test my worst performing day. Yeah, I'm not real big on trading Fridays. I think I'm going to stick a fork in this one. We should all short CNBC for showing ads. That's unbelievable, SG. Unbelievable. What is the best futures pair you suggested, Shane? I'm showing you what I trade. I like crude oil, gold. I like trading crude oil, gold, the E-mini S&P 500. E-mini NASDAQ, live trading, it's problematic because the ranges are so big. So I usually take that one down to maybe a micro contract where you're not trading that big leverage. But definitely, you're going to probably looking at the NASDAQ, the S&P 500. The E-mini Dow is another good one. It's just lighter leverage, that's all. But gold and crude oil, for sure. That's for sure. BTC still bleeding. Let's go ahead. Take a look at BTC. Our dollar-yen trade looks like that one's going to set up beautifully. Here's BTC. There's Bitcoin weekly chart. Still in the positive for the week. Let's go to the daily. Daily right there, you're off about 1%. I wouldn't say that it's bleeding too badly, really. Let me see. Not really. 82,000 now. I mean, 79. So we're looking at the Bitcoin right there at about 79,000. All right. Let's see. One more question, guys. Then I'm going to go ahead and sign off. I'm going to go lick my wounds, take my loss, and go home. I mean, you could sit here and try to get back to even, but for me, it's all about ripping Band-Aids off when it's time. Just rip it off. See that right there, guys? You don't want to be you don't want to be any part of that. The market broke for no apparent reason. You can't be holding up here. 71. Let's say we're holding that position at 71. We're short here. We're short 2 lots. So that draw right there would have been what? Let's just go 10 points. 10 points times 4 ticks, right? That's 40 ticks times $25 a tick. What are you down? We would have been holding that down 1,000. It's not worth it. Hey, listen, I know cutting those trades off hurts. It sucks. I don't like it, but take a look at it. Your first loss is your best loss. So our probabilities are down. We haven't been hitting these things with as high a probability as we had been the last few days. I think we're working on, 3 losing trades in a row? That's pretty rare. That's pretty rare for me. So we'll be back next week ready to go. But right now, not interested. Not interested. Going to take the profits for the month and move on to September. That's what I would say. Remember, don't go on tilt. Don't give the money back to them. Don't do it. If things aren't going well, cut your leverage, be patient, game plan, study your losses. What happened right here? We took a shot, we cut it off. There's nothing wrong with that trade. Think about the fundamentals, hawkish dollar fundamentals. Why would this be breaking out? Why would you see early day trading in your U.S. indices break higher? You wouldn't. It's just noise at this point. Maybe if you wanted to sell, maybe a late day sell would be pretty good. I thought the sell on the E-mini Dow was probably the trade we should have waited for, but we just got in there and took a trade to see what we could do. I do like those range trades, though. Those news-based ranges, I do like those range trades. That one did not work, and it didn't work in a big way. So there you go. All right, couple questions here, and then we'll go ahead and sign off for the day. Let me see. Timbo, what are your thoughts on the progress of the Clarity Act with regards to crypto? I mean, I think it's DOA. I don't think that the Trump administration and Congress right now wants to do anything regulatory towards crypto, even if it's seen to be a positive. They don't want to do anything regulation-wise. They want that to be the Wild West. I mean, listen, I'm not anti anybody, okay? That's the biggest thing I want to stress here. As far as being viewed as a political monster, I'm not. I would say that I like policies that help, not hurt. And so I'm typically in favor of private sector business. I'm a capitalist. I don't like the government getting involved in a lot of things. However, when you start talking about crypto, the lack of any sort of oversight or regulation is a fascinating topic because we don't really know the role of crypto in 5 years, in 2 years, in 10 years. We don't really know. So in one respect, to regulate crypto is sort of problematic. But in the other respect, if you don't regulate crypto and you don't have any sort of oversight at all, and realistically, there's no oversight here. There isn't. The SEC's tried to get involved here and there, and they've prosecuted a few folks for money laundering issues and maybe some fraud issues, and that's great. That's really what they need to be doing. But as far as regulating exactly how things are traded and what coins are listed and how the process of funding these projects, these blockchain projects and blockchain initiatives, there really isn't much there. Now, it's hard for me to believe that any sort of regulation is coming to crypto. And the Clarity Act is viewed as being widely as being a positive thing. I don't know that that's the case. The idea is that there's going to be some order in there, and that's going to bring more investors in saying, okay, well, maybe this really is like our other markets. But I find it hard to believe that some of the folks that are making a huge amount of money want any of that regulation. And a lot of them are in Congress, and Trump himself made $2 billion on crypto over the last year. That was in his financials. $2 billion with a B. Trump Inc. did. And a lot of that came off the Trump coin, the Melania coin, all those coins that aren't worth anything now. Lutnick's into crypto in a big, big way. His sons run Cantor Fitzgerald, which is an insurance firm. They used to offer binary options. They still might. They're into crypto. Barron's into crypto. They're all into crypto. So to sit around and think they're going to pass any sort of meaningful crypto regulation, that's not going to happen. Now, next year, the Democrats are going to be in control of the House of Representatives. More than likely, I think they're going to win the Senate as well. I see a big blue wave coming. I don't think there's any way around that. There's still a lot of time till the election, though. It may change. But if you have a Democratic Senate, are they going to want to regulate crypto? Yeah. The last administration, remember Biden, SEC Chairman Gary Gensler? They loved going after crypto. They went after crypto every other week. There was a new altcoin provider that was drug in front of some committee. So it's up in the air. It really is up in the air. I think crypto regulation, I'm surprised it hasn't come yet. And a lot of people are going to argue with me, and they're going to say, no, there's crypto regulation. It's regulated. Not like a security, it isn't. Not like CFT, like the CFTC regulates futures contracts. It ain't like that. I'm sorry, it's not. And that's what a lot of investors are looking for. But the same investors that are making a ton of money off of the way crypto works right now, they don't want it changed. And those are the people that are in control. Now, that may change next year. I think the biggest market driver for crypto probably in 2027 isn't going to be interest rates. It's going to be regulation. It really will be. So we'll wait and see what happens. That's for sure. Eli, can you explain how Meta stocks are going up? No. AI. The data centers. I mean, Meta's a major player in cloud computing and also in the data centers. I believe they're building one in Louisiana. They want to be on the lead lap. I believe it's a Meta one, yeah. Yeah, so here you go. This is a monster. Meta's building a massive $50 billion artificial intelligence data center, campus nicknamed Hyperion in Richland Parish. Look how big it is. Scaled up to 5 gigawatts of compute capacity across a footprint spanning 3,200 acres. Full operations targeted to 2030 and 36. So if you're asking me why Meta would be going up, it's because they're positioning themselves to be a major player in the AI space. And honestly, we just heard the chairman of the Federal Reserve go on and on and on about AI. I mean, he was gushing about AI. He was talking about AI like you would talk about your star quarterback. I mean, he goes, AI, and I go, okay, whatever. The only thing that's really going to constrain AI is the actual physical inputs. If you don't have energy and you don't have the water to keep these things cool and you don't have the real estate and you can't get the local governments to go along with it, AI has a problem. It will have a ceiling. That means those data centers, as soon as that gets constrained, right now it's the Wild West. They're building them everywhere. Why on earth you would be using resources that support your human infrastructure to build AI infrastructure? I don't know. Money, bottom line, it's money. That's something I genuinely don't understand. But there will be, the energy situation is very real. And that's why the trade war with Canada right now, the Trump administration decided they were going to fight with Canada. Canada exports a tremendous amount of energy to the United States. Energy is a major, major, major ingredient to AI. Any cut on the energy grid, any cut of the energy inflows into the United States is going to hamper AI in a big, big way. So Trump is trying to start a fight with Canada. I don't know that you want that fight, because if they shut down the energy, you kiss your AI boom goodbye. Why is Meta going up? It's because they're going to be a player in the new world, and the new world looks to be like it's SpaceX. It's going. You wait till you see some of these IPOs. Anthropic, OpenAI. They're going to have their IPOs, and they're coming in the next 6 to 9 months. Those are going to be huge. They're given time. They're given time right now for this one to recover. SpaceX still what is it trading? Right around 142. Okay, so I mean, the washout over. Boom, boom. Out go the lights for the retail longs, just like our S&P 500 short, right? Boom, boom, out go the lights for everybody that was holding from 150. You got knocked out. Unless you're buy and hold, and buy and hold's a different game. Right there, 135, though, institutional open. That's where the big dogs got in. That looks like it's going to be the support zone. 142. More than likely, you're going to trend higher here. More than likely, you're going to trend in SpaceX. So put your thinking cap on for a minute, guys. If, in fact, you are Anthropic, if you're Anthropic and you're OpenAI and you want the big payday. You don't want to have a decent IPO. You want to have the biggest IPO ever. You want this price of SpaceX to start trading right back up here around 200, and then you would start talking about launching your IPO. They've delayed theirs. They were going to launch in September earlier this year. They're not. Now we're talking 2027 for these launches. I think they want, this is the canary in the coal mine. It really is. Largest IPO ever, the new world, right? The new frontier. Anthropic and OpenAI are right behind. So how does all this figure into Meta? Meta sees themselves as being a major infrastructure player for the whole Marianne. I mean, you don't build an infrastructure that large. You don't build a data center that large unless you want to be a player. So you ask me why Meta stock is going up? Pure speculation. Pure speculation. But they're going to be a player. It was a big week for AI. The chairman of the Federal Reserve just came out and talked about AI like it was his son on his knee going, "Oh, I love you, AI. I love you." That's where we're going to get our economic growth from, is AI. Maybe, maybe not. I don't know much about it. I do know charts, though, and I do know prices and markets, and I've seen a few bubbles in my life. Is this a bubble? I don't know. You never know at the top of a bubble, right? We do know that what can pop it, though. Energy. Higher energy prices will pop AI. They'll blow it out. Also regulation. If you do see the next administration start regulating AI, that will hurt as well. Rare earth minerals and all that stuff as well. The constraints, the actual components of these AI things. That's what will constrain it eventually. All right, we've got a couple things here, and then I'm going to go ahead and sign off. They lost so much money in their lawsuit. Yeah, Eli, they just wrote it off. They just write it off, right? They just wrote it off. Most companies have like a goodwill expense that they spend on public relations and making everybody love them. That's basically what Meta did. They just took the big settlement. What was it, $16 billion? They just took the big settlement and said, "Yeah, pay them. That'll be good for our image later." And they just write it off their balance sheets. I'm not saying it's not a lot of money, because it is. But if you settle class action settlement or you lose or whatever, you get to put all that to bed and nobody has to worry about what you're doing on your platform anymore. Crazy. The whole Meta social media thing's insane. I mean, it's really wild, man. Let me see. Eli, communism. You have 2 cows, you give them to the government. Socialism, you give 1 cow to your neighbor. Capitalism, you sell 1 cow and buy a bull. Yeah, when I was young, I grew up actually on a ranch. Spent a few years on a ranch in my younger years. I remember when they went to the bull sales to buy bulls. You know, you're talking about 15, 20, 25, 30 grand for a good bull, and that's sort of low end. They can go way up into the hundreds of thousands. But the ones I saw, they were buying them for about 20,000 a piece. That was back in the 90s. And the bull sales were just like these giant parties. I mean, these ranches would throw these sales, and these people were taking private jets in, and there was so much money flying around. Money, food, a lot of alcohol. The ranchers, the cowboys always were drinking. Cigars. It was really something to see. I'm glad I got to see it. Let me see. 512. Eli, crypto was made to get away from the dollar. Now it's backing the dollar. That's funny. That really is funny. Better start yeeting your 401k into the energy sector then. Naomi, I'm glad you're smiling, Naomi. Good day. It's always a good day if you're smiling. Thanks, Shane. Your time is always appreciated, and that is my time for today. We ran way long. I want to thank everybody for joining me. One last thing I will stress. I don't like to lose. I don't like to lose. That's why the way that I trade, that's why I trade the way I do. I trade for high percentages. I like to win a lot. I like always trading in the green. This week, it just didn't really happen for us. We've lost 1, 2, let's see, 1. We took a small loss. Uncle, so 1, 2, 3, 4 trades in a row. 4 trades in a row. That is rare, but it does happen. What these trades, though, you can go back to that gold, small loss there, saved us from a big loss. Copper, that one sucked. That was not a good trade. We had volume dilution. We went with the trend and got chopped out of that, and we got slippage of about $75. That wasn't good. NASDAQ futures, that was a pretty good trade. We cut that one off. That ended up trending against us as well. The second NASDAQ futures, we messed up our entry point, went from the POC instead of 62%. That could have been a winner. That probably was the swing in our week. Don't count the natural gas. We just got a little bump on that. That was sort of an entry that we left the order in the queue. And then today, we got hit. We got hit again. Stuck to our guns, though. I really want to point out that Our stop loss was right there. So you don't want to go for rides on these things. That is how 95% of the people lose their money, realistically. Well, the market wasn't trending, and then it broke out. It's still not trending. You're only up 0.5% on the S&P 500. You're only up 0.5%, but you have to really take a look at that 1 minute chart and say, yeah, there was our compression right up sort of at our high. That was right here. I think our stop loss. Yeah, that was our stop right there. Here was our entry. Sort of here was our compression. We had a chance maybe to get out right there. Trade didn't go our way. Went higher, we got out. If you're still holding that shorts, that's an account. I mean, you blew your account out more than likely. If you're trading a $5,000 account or even a $10,000 account, you really hurt yourself. You really hurt yourself. Your first loss is your best loss. Now, I'm not going to sit here and sugarcoat losing because I hate it. I absolutely hate it. But when you lose with class and you lose in a structured fashion. You don't sit here and if you're still holding this up at 77.77 and you're short from 77.65, you're praying and hoping right now, and that means you're already a dead duck. Take the small losses. Stick around. Even if it goes down and gets your points now, who cares? Who really cares? It's not worth the risk. You can't hold those positions. You just can't hold them. All right, try a warm tea with 1 shot of tequila. Mom's recipe. I got a big weekend, though. University of Montana Grizzlies, home opener tomorrow night, 7 p.m. in Washington Grizzlies Stadium. I'm going to be there. I got season tickets. Take Dad down, go saddle Dad up, and we'll go down and watch a little football. So I may not have any voice on Monday. May not have any voice on Monday. All right, everybody, that's a wrap. Red week, slow week, does not surprise me. The last week of the summer, essentially. Next week's going to be interesting. We're going to sort of open the can on September trade. Labor Day is going to be the following week, so we're actually going to have sort of another dead week in here. But I am interested to get started here unpacking what is going to be a fantastic fall season. We're going to put August to bed, and we're going to turn the page into September's trade, and I'm very much looking forward to it. So I want to thank everybody for joining me today. The biggest thing we can take away from Kevin Warsh, what? He basically set the stage that they're going to hike interest rates. And he also said that, hey, AI is his best friend. He loves AI. I love you, AI. That's basically what Warsh was saying. And then also he said there's going to be some changes. There's going to be fewer engagements. There's going to be a different Fed moving forward, and he's already getting you ready for that in 2027. So big-time announcements today. I don't think he's a very funny guy. If I was him, I'd lay off the jokes. I don't think that he needs to be doing that. But the rest of it, interesting engagement. We got a little bit of movement out of the markets now. I would be watching WTI crude oil the rest of the session. I expect it to rally, maybe close near scratch somewhere right around $85. I don't believe you're going to go in down crude oil to the weekend, but there is optimism that the Strait of Hormuz is going to be open and that the Iran war is winding down. We will see. Minor setback for a major comeback. Oh, I'm not worried, too worried about it. We'll see. If we're in the red by Friday next week, I'm not going to be a happy man. I'm going to have to go to the mountaintop over that one. Tuku, absolutely. You're welcome, Jeanette. My pleasure. All right, guys, I'm going to go ahead and sign off. Have a fantastic trading session. Get away from these markets for a while. If you're going to take a break this weekend and next week are probably a good one. Good time to do it after Labor Day, man. We're going guns blazing. It's all hands on deck and all systems go. All right, everybody, have a fantastic trading day. As always, trade the action well, and we'll talk soon.